Are we rolling? Awesome. Welcome to the first episode of Finance Unfiltered. I'm your host, Susan, and I'm joined by Luke McCarty of McCarty Wealth. Luke, been looking at the markets all morning. Feels like a bit of a roller coaster out there.
Yeah, honestly, Susan, it's been a roller coaster for the last few months. That's why we're doing this. We're going to look at the numbers, but more importantly, the reality of what people are dealing with.
Perfect. Let's talk about it. Let's start with the big headline. With everything unfolding in the Iran conflict, a lot of investors are feeling really shaky right now. Have you made any tactical changes to your client portfolios in response to the news?
Yeah, we have. So we own some oil stocks and energy stocks. Last year and into this year, we bought some more, not knowing or expecting that the Iran conflict was going to break out. But when it did, right, we sold those two positions, ExxonMobil and Diamondback Energy, when oil was above $100 a barrel. Right, so now oil, of course, has came down. It's gone back up. We've had a ceasefire. We've had not. It's kind of bouncing around, going back lower to $60 a barrel. Right, and so what we did with those proceeds of the sale is we bought emerging markets. So emerging markets are net importers of oil. When price of oil goes down, their economies do better. So if our prediction of oil going down is correct, it's going to lead to the emerging market sector to outperform probably in the long run.
It's really great that you are able to proactively make these changes in response to the news.
Yes, definitely. And of course, we've had a lot of client fears and client worries. President Trump has had quite a few speeches at prime time. Even the most recent one, not all the news channels, showed it.
Right.
But I've had some clients worried about, well, what if we put boots on the ground? What if we do something different? What if this? What if that? So a lot of concerns from our clients about the Iran conflict.
Yeah, I bet. Moving from geopolitical news to the domestic side, I'm looking at the rest of the year, a bit nervous. There's a new Fed chair, and historically...
the new Fed chair, historically 11 of the last 13 times we get a new Fed, the market dips in that first year, more like the first 6 months. So Kevin Warsh just took over. One of the things he's trying to do, probably reduce communication, right? Mm-hmm. Could be good, could be bad.
Yeah.
I don't know. Sometimes we as investors, we as the market, we dissect what the Federal Reserve Chairman says too much.
Way too much.
Whether he's thinking of interest rate hikes or interest rate cuts, so that's potential change. There's also, he's going to set up 5 main, I think it's committees, is that what he called them? Task force, yes. 5 task force to review what the Fed is doing. And so there's potentially quite a bit of changes coming out. But, big picture, inflation's still above the 2% goal of the Fed. We've been above 2% for a really long time. You feel that at the grocery store, right? Your home prices, a lot of things are still rising with inflation. So their job is not done.
What would you do differently?
If I were the Fed chair?
If you were the Fed chair.
So great question. This is funny. So I don't know if you knew this, but in college, I tried to get an internship with the Federal Reserve of Kansas City, and they didn't like me, right? So I didn't get it.
Their loss.
So I went accounting instead. I went tax accounting, and then I had one at Raymond James. So I did have the 2 internships. But if I were the Fed chair, I'd probably revamp the whole thing and say, okay, it's inflation plus maybe 1%, inflation plus 1.5%. That would take out a lot of the political back and forth, a lot of the let's get in a room, let's go to Jackson Hole and spend all this money and raise our hand and vote if interest rates are up or down. I think it should be systematic, and maybe that could solve some of our problems.
And we've been talking about those rates for so long. Are they going to raise? Are they going to lower? What's your outlook?
Yeah, so my outlook is I think the Fed is going to cut rates. June inflation was lower than expected. It was actually negative. It was actually deflation for the first time probably since maybe a little bit after COVID. Bond market itself thinks the opposite. So I'm not saying I'm smarter than the bond market. I'm not smarter than these bond math gurus. But if inflation's coming down, if we get a resolution to the Strait of Hormuz and the Iran conflict, right, then we should see less pressure on inflation. Right? Kevin Warsh wants to cut interest rates. President Trump put him in there to cut interest rates. But now that he's there, he doesn't have to listen to the president. So they do stay independent. But I think my view is that we may have a rate cut or 2 by the end of the year.
And what kind of opportunities does that present for your clients?
Yeah, so the opportunities there, right? The bond market, bonds do better when rates drop, which is why bonds haven't done that well since COVID. Mm-hmm. Bonds did really well from 1980 to 2020, haven't done that well since. So the outlook there is that bonds will do better. If rates fall, gold could potentially do better. Your flight to safety. There's also $7 trillion of money market on the sidelines. And if those rates from maybe your money market account, like for instance, our accounts at Schwab, right? Mm-hmm. The money market's paying 3.5%. Well, if that starts dropping, let's say 3%, 2.5%, 2%, you're going to look for some other alternatives with your money. So we could see a lot more investing back into the market.
For the folks who don't want to gamble, the traditional safety net has been bonds. Mm-hmm. So now that bonds aren't necessarily working, how do you advise a conservative client? Where should they put that money?
Yeah, so our portfolios, we still own the short duration bonds. So we own bonds closer to maturity. When you think of a bond movement with interest rates, the longer term the bond, the more it moves, like a pendulum. So we're still on the shorter end of things. So we have less movement from interest rates. And think of it as clipping 5 to 6% coupon with not a lot of interest rate risk. So if we're going to own bonds right before the Fed really signals what they're going to do and before they start cutting interest rates, I think that's the place to go, because this year, right, interest rates have actually gone up, right? The Fed hasn't raised interest rates, but interest rates have gone up with the Iran conflict, with the fears of inflation, with the government printing too much money. So short duration bonds are where we're still sitting. I also like buffered ETFs. So you can get a buffered ETF, meaning you don't lose some of the downside, but the ones I'm speaking to and buying for conservative clients have 100% buffer on the downside.
Wow.
So, okay, well, that sounds too good to be true. Look, I own this ETF that can't lose money. Well, what's the catch? Right, the catch is you can only make 6, 7, maybe 8% on the upside for that year. So we've been laddering these into client portfolios by buying them monthly and having this maybe 6, 7, 8% rate of return potential in the markets going forward. And if you were buying these in 2023, 24, 25, looking like 26, you hit those upside caps of 6, 7, 8%, whatever they were. And if you go back to 2022, bonds were down 15, stocks were down 18, well, you took a zero there. So you've outperformed the bond market by a lot, and you've taken a lot of your risk off the table with those buffers.
That's great that your conservative clients can participate in the market and still have that safe space.
Correct. So that's if you want to keep things liquid. So those buffered ETFs, we buy today, for something happens tomorrow, we can sell them. The other ways to structure a conservative portfolio in this environment is to look at annuities, maybe like a MYGA, a multi-year guaranteed annuity. Think of this as a CD with more juice, right? Instead of getting the 4%-ish rate on a CD, you're getting 5 or 6. You can look at a fixed indexed annuity that has the upside cap of maybe 10-ish, higher than the buffered ETFs, but you run into those liquidity problems where if you want your money out, you really can't get it. So you have to be very careful there. Some other alternatives, maybe some real estate, past gotten into apartments, data centers, farmland, quite a few different things we can do besides bonds, which, as you can tell, I don't like bonds and I haven't liked them since COVID.
It's good that we have options.
Good that we have options, right?
So the takeaway I'm hearing, oil down, a new Fed chair with something to prove, and bonds still on the bench?
Yeah, bonds are still on the bench for sure. So that's the picture. It's not a market where you just set it and forget it. It's a market that you plan around.
And that's exactly what we're doing here. Next episode, we're tackling the most polarizing word in finance, annuities. Yes or no?
Oh, I have some strong opinions on that one, Susan.
I'm counting on it. Today raised any questions in your own portfolio. The links to connect with McCarty Wealth are right below. We'll see you next time on Finance Unfiltered.